Are the best days behind us, or is this a big old buying opportunity? Steve Grasso, kick it off.
I think the best days are behind for tech. If this is a textbook rendition of why you don't buy growth in a rising rate environment. Everyone on this panel has talked about it. Other panels on the show have talked about it. This is something where what's unbelievable to me, though, Melissa, is that everyone will rush back in. Human nature is you only buy what you know. So people think they understand an NVIDIA or a PayPal or a Salesforce. So when they sell off, what do they think? Buying opportunity. And until you really get burned a number of times, you continue to rush into that burning house. So I think when people start to expand their base of stocks that they, quote unquote, know, you're going to see this repetitive nature of getting burned time and time again. So I do believe you're going to see the Russell continue its outperformance. I do believe you're going to see chemical names, material names, industrial names continue their outperformance. So for the near term, tech's best days are behind it.
Oh, that's quite a metaphor, Grasso. I mean, to compare certain tech stocks to a burning house, rushing in, getting burned, et cetera. I mean, Nadine, can you look me straight in the eye and say Alphabet's a burning house or Apple's a burning house? I mean, I thought these were value trades in technology. We're seeing this sell-off pretty much indiscriminate across tech stocks, harder, of course, amongst the higher multiple names, but also taking the big cap tech stocks. Is that the way we should look at this?
Well, I agree with you in that wouldn't call them burning houses because fundamentally they're pretty solid, right? But what you do see right now is there's more downside than upside. I think that's what Steve's getting at here. We're looking at last week when there was a lot of volatility. These things were trading at an implied volatility premium. What does that mean? It means that people are paying more for protection last week. But this week, they're trading at a discount. So a lot of that protection that they bought at expensive prices, they either unwound it or they're not buying it this week. So the asymmetry, which I think is what Steve's getting at here, is really not in your favor. So you have to be really careful. So what do is we do trade the chop. So it's not to say that you get to buy on one day that's a dip and hold forever. It's more of a trading environment.
Yeah, Jeff, from a previous call when we were planning out the show, that's what it sounded like how you viewed tech trade right now, that it's tradable at this point.
Exactly. I think Nadine phrased it absolutely perfectly. And I agree with everything Steve said, with the caveat that I think it's maybe tradable in the very short term. So if you think about stocks like Facebook, Amazon, Apple, throw in NVIDIA, Spotify, these are companies that are now at longer term technical support. So I think that's a good thing. And if you go to last week, you only had 20% of the triple Qs trading above their 50-day moving average. That's usually a pretty good signal of at least a tradable low. It's not always perfect timing, but I think it gets you in the neighborhood. And I think sentiment in terms of bonds is becoming pretty bearish right now. So rates could trade sideways for a bit, so then you could play this oversold condition that we have right now in tech. But I do think that cyclicals rule the day longer term. And I think a lot of it is going to come in the summertime when we get these inflation fears. You know, right now, if you look at 40% of the people who aren't working, they're actually making more money because of the stimulus than they would if they had jobs. So I think you could have this labor shortage just as the economy is starting to pick up steam. Folks get really concerned about inflation. And what does that do? It pushes nominal interest rates higher. Not good for tech. On the flip side, I think what that does is it pushes real rates actually lower, so it continues to force people out the risk curve into stocks, and it's likely into cyclicals under those conditions.
Yeah, Bonawyn, do you think tech is oversold right here? And do you think it's tradable? Or do you think the play is really to just go all in cyclicals?
No, I definitely don't think that the play is going all in cyclicals, but I think that there's a lot of merit to what the other panelists have been saying. Right. So the way I really like the question that you asked, and what you said is, you know, are the best dates behind it? Well, are we going back to a pandemic-induced situation where tech is going to outperform, where we're at historically low rates? That's not coming back. So to expect to make 400-500% in these names, I think that's a bit outlandish. So do I expect that to be replicated in the short term or long term? No, I don't. With that said, I do not think you should be throwing out the baby with the bathwater. There are different subsectors within technology. Facebook, Apple, these names are trading in high 20s price to earnings. Google's trading at like 30, 31. compare that to some of these names like CrowdStrike that are trading at 200-300 times price to earnings. So there needs to be some decoupling. So I'm just not with the notion of saying tech as a whole, you can't invest or trade in it. I do think you do need to slide further back on the risk curve into names that have fortress balance sheets, that have shown sustainable growth and have a use case now and in the future.
Shepard Smith here. Thanks for watching CNBC on YouTube.